Prices at the pump are reaching record levels. The national average for gas prices has increased to $4.32 at this point. Some of the areas of the country are actually seeing prices over $5 a gallon, and I've seen pictures of $6 a gallon in places like California. Joining us right now with a look at some of the sectors that might feel the pain at the pump is Sarat Sethi. He is managing partner and portfolio manager at DCLA, also a CNBC contributor. And Sarat, these higher prices, how quickly is that going to reflect in terms of a shift both in stock prices and in terms of consumer spending habits?
So I think we've seen the former first. The stock prices have started to reflect this pretty quickly, Becky. If you just look across some of the retailers, look at like Starbucks or look at, some of the consumer staple companies or FedExes of the world, they've all reflected it. Their multiples have come down multiple turns. The question now is, when does this affect the consumer? And in our view right now, the opportunity is that we have this pent-up demand. So we're getting into this, quote, what we thought was the reopening play that is in the face of higher input costs. So the question is, and this has been a question for months now, how transitory are these costs, especially the oil and gas costs that people hadn't built in? Inflation expectations are already there for the consumer. I think if you understand and people know that everything's more expensive, our view is let's see how long this lasts, because if the oil prices start coming down, you'll see demand not being impaired.
But when you say this is an opportunity, you think stock prices in some arenas have dropped more rapidly, multiple compressions come in, and maybe the business won't feel it just yet. Maybe they'll get by just fine because there's consumers so strong right now?
I do, and I think the difference is coming out of the pandemic to the endemic stage. Consumers are looking for experiences. We've been talking about that for a while. They're looking to actually go out, get out of the home. Instead of just buying goods at home, they want to be out there. So companies like a Disney that have that opportunity of not just the amusement park, but then you get the flywheel of also experiences on streaming. Companies that can pass through prices. I mean, look at a company like Amex or Visa, MasterCard. If things start increasing just by a little bit and you don't see a huge pullback, they're going to just have huge operating leverage. Where I think we're going to have issues are companies that do not have pricing power. So companies that don't have good brands, that are on grocery stores, that consumers will move to private label. That's starting to happen already. So you have to be really careful there. Do you have that operating leverage and the brand? So I think parsing out who's going to actually grow their top line without affecting higher input costs, that's going to be where I think the stock picking is going to be really important.
Shepard Smith here. Thanks for watching CNBC on YouTube.